Is this EV giant flashing massive, just screaming sell signals in a falling trend? Or is it a heavily undervalued strong buy right before a major earnings report?
That is the million-dollar question, isn't it?
It really is. Welcome to today's deep dive. We are taking a magnifying glass to the real-time data, the financials, and the very weird insider activity for Tesla.
Yeah, weird is definitely the right word for it.
Right. And tomorrow, April 22, 2026, they drop their Q1 earnings. The stakes are absolutely massive, and our mission today is to figure out exactly what all these conflicting signals mean for you and your portfolio.
Exactly.
Before we jump in, take a second to like the video and subscribe to our YouTube channel. And it is completely compulsory that you leave your feedback in the comments. We want to know your predictions.
We read all of them. But just a quick disclaimer before we really get into the weeds here. While we are going to look incredibly closely at this data, this is purely an educational debate. We're exploring the market landscape, but this is absolutely not financial advice.
Okay, let's unpack this. Because looking at this stock right now is, it's like trying to read a compass inside a magnetic storm.
That's a great way to put it.
Every single indicator is just pulling in a completely different direction. And before we even peek under the hood at the company's actual financials, we have to understand the market psychology today.
Right, because the market's perception heading into an earnings call often dictates the immediate reaction way more than the fundamental reality of the balance sheet.
Exactly.
If expectations are wildly misaligned, even a decent earnings report can trigger a massive sell-off.
Which makes today's trading action incredibly telling. Let's look at the numbers. As of the April 20 close, we are sitting at a quote of $392.50.
Which is down, what, around 2% for the day?
Yeah, down 2.03% to be exact. But the intraday action, the actual minute-by-minute trading, was just a total roller coaster.
Oh, it was a mess.
It opened at $402.58, faked everyone out with this quick spike up to $406.80, and then violently shed almost $20 a share before lunch.
Yeah, dropping all the way down to $388.33.
Right, settling near that $388 mark. That kind of intraday whiplash tells you traders are incredibly nervous. They have no idea what to do.
And if you zoom out and look at the 52-week range, that nervousness makes perfect sense. We saw a high of $498.83 back in December of 2025.
Almost $500.
Almost 500. And a low of roughly $222 exactly 1 year ago on April 21st, 2025.
Wow.
When you have a mega cap company with a spread that wide over a single year, it tells you the market has fundamentally lost the thread on how to value the business. It's just a schizophrenic chart.
Schizophrenic is the perfect word. Because if you look at the official trend direction, it is classified as neutral to bearish in the short term. The stock is down 12.28% year to date.
Yeah.
And yet, if you isolate just the last 5 days, there's this weird 7% upward pop.
Just out of nowhere.
Right, so you turn to the technical indicators hoping for some clarity, and the confusion actually just gets worse. The Relative Strength Index, the RSI, is sitting at 56.
Which is the market literally just shrugging its shoulders.
Oh.
For context, the RSI measures the speed and magnitude of recent price changes to evaluate if an asset is overvalued or undervalued.
Yeah, it's on a 0 to 100 scale.
Exactly. Anything above 70 means the stock is overbought, probably due for a pullback. Anything under 30 means it's oversold and might bounce. So sitting right at 56 is the mathematical equivalent of total indecision.
But then you look at the momentum indicators, and they are telling a completely different story. The amount of ED is sitting at 4.86. And it is actively flashing a buy signal with positive momentum.
Yeah, that's where it gets tricky.
And at the exact same time, the moving averages are a total mixed bag. The current price is hovering above the 50-day moving average, which is about $375.11. That looks bullish. But it's bumping its head right against the 200-day moving average, which is sitting at roughly $376.50.
And that 200-day moving average is critical. Institutional algorithms and massive fund managers use that specific line as a barometer for the long-term health of an asset.
It's a huge psychological level.
Huge. When a stock is trading below it and tries to cross back over, that line often acts as heavy resistance. Selling pressure naturally kicks in because traders who were trapped at higher prices, they use that rebound to finally break even and exit.
Okay, wait. I have to push back here.
Go for it.
How can the MCD be actively flashing a buy signal and the stock gain 7% in just 5 days, while the overall trend is still officially classified as neutral to bearish, and it's facing massive resistance?
It sounds contradictory, doesn't it?
It feels like telling me it is sunny outside, but I should still expect a blizzard. How does the math actually support both of those things at once?
Well, what's fascinating here is how short-term momentum can act as a total mirage, mathematically speaking.
Okay.
The MCD, the moving average divergence, is an indicator that compares a short-term moving average to a longer-term one. That 7% pop over the last 5 days you mentioned,
Yeah.
that sudden recent speed is exactly what triggers the MCD to cross over and flash green. It is only measuring the immediate velocity.
Oh, I see. So it's completely blind to the larger context.
Precisely. Short-term momentum can completely mask underlying macro weakness. And this is exactly why retail traders often get trapped.
They see the shiny green button.
Right. They open their brokerage app, they see a bright green buy signal next to the MACD, they see a 5-day winning streak, and they jump in.
Makes sense.
But they don't realize that in the context of a 12% year-to-date drop and the heavy algorithmic selling pressure looming in that 200-day moving average, they might just be buying the peak of a temporary dead cat bounce inside a larger falling trend.
Which is absolutely terrifying if you're allocating capital right before an unpredictable earnings call.
Highly risky.
Because the surface-level technicals are screaming these mixed signals. We really need to pivot. We have to look at the hard fundamentals, the actual income statement and the balance sheet.
Because technicals just tell us what traders are feeling.
Exactly. We need to see if the actual underlying business justifies a stock price hovering near $400.
We have to separate the narrative from the math. We need to see what the company is actually generating in real dollars and cents.
Let's rip the Band-Aid off.
Do it.
Looking at the trailing 12 months, the income statement is, it's not pretty. Revenue is stagnant at $94.83 billion. It is completely flat year over year.
Flat revenue is never great for a growth stock.
Right. But much more concerning is the bottom line. Net income has plummeted 46.79% year over year, dropping down to $3.79 billion.
Ouch.
Yeah, and diluted GAAP earnings per share is sitting at just $1 and down.
A nearly 50% drop in net income while revenue remains perfectly flat is a massive flashing red flag.
Huge.
Mechanically, that means their costs to produce and sell the exact same amount of goods have skyrocketed, or they are aggressively slashing their prices just to maintain that flat revenue.
Which we've seen them do, right? The price cuts.
Exactly. Either way, their profit margins are getting completely crushed.
And just to clarify for you listening, GAAP earnings, generally accepted accounting principles, that's the unvarnished truth, right?
Raw numbers.
Yeah. It includes all the messy expenses that companies sometimes try to hide in their quote-unquote adjusted earnings reports. So they are making half the profit on the same amount of sales.
Right.
But then you flip over to the balance sheet for the most recent quarter, and it is built like an absolute fortress.
It really is.
Total assets are sitting at $109.2 billion. They have $26.9 billion in cash and equivalents just sitting in the bank.
Which is staggering.
And their debt-to-equity ratio is an incredibly low 0.18.
And you know, in the automotive industry, a debt-to-equity ratio of 0.18 is practically a superpower.
Really? Why is that so unique?
Well, building cars requires massive factories, complex global supply chains, and enormous upfront capital. Traditionally, legacy car manufacturers fund all of that by drowning themselves in bank loans.
Okay. So for every dollar of equity they hold, they only owe 18 cents in debt.
Exactly. There is virtually no toxic leverage weighing this company down. It means that no matter how badly their margins get crushed in the short term, they aren't going bankrupt tomorrow.
They have a massive cushion.
They don't have massive interest payments eating away at their cash reserves. They own their destiny rather than their creditors owning it.
Okay, that is a crucial safety net. But they might be burning through that cash reserve much faster than the market appreciates.
Let's look at the cash flow.
Yeah, let's look back at the historical context from Q1 2024 to understand the real cash flow reality. Operating cash flow essentially collapsed to just $242 million.
Wow.
And free cash flow went negative. Negative $2.5 billion.
And the sources point out exactly why that happened.
Yeah, the data shows it was driven by a $2.7 billion inventory buildup, alongside $1.0 billion in AI infrastructure capital expenditures.
And that single data point, the combination of building up physical inventory while simultaneously spending billions on AI infrastructure, is the entire story of this company right now.
It really is.
It explains the entire valuation debate.
Let me put it this way. Imagine a local business in your town. They are spending millions building this massive state-of-the-art sci-fi server room in the back of their building. But out front, their parking lot is completely jammed with unsold physical inventory that is just gathering dust in the sun.
That's a great visual.
So what does this all mean for the company's actual real-world health?
That is a phenomenal analogy because you have to distinguish between two very different types of cash burn. Not all negative cash flow is created equal.
How so?
On one hand, you have bad cash flow burn. That is the $2.7 billion tied up in unsold inventory. When you have cars sitting on lots, they are depreciating
Right, they
assets.
aren't fine wine. They don't get better with age.
Exactly. The technology inside them gets older, the batteries degrade, and it represents a fundamental mismatch between what your factories are producing and what consumers are actually willing to buy today. It is terrible for cash flow because your money is literally trapped in metal.
It is dead weight that you eventually have to discount just to get rid of.
Precisely. But on the other hand, you have strategic cash burn. That is the $1 billion in AI infrastructure capex.
The sci-fi server room.
Right. The server room, in your analogy. That money isn't wasted. It is an active investment in a future business model. Because they have that incredibly low debt-to-equity ratio and nearly $27 billion in the bank, they can comfortably survive this massive cash drain.
Even if it looks terrible on paper.
Exactly. It looks absolutely terrifying on a quarterly earnings report to see a negative $2.5 billion in free cash flow. But structurally, the patient is not bleeding out. They are intentionally drawing their own blood for a future transfusion.
Okay, so if they are intentionally burning billions to build this AI future, how on earth do you put a price tag on that? Because when you look at Wall Street's valuation models right now, the math is literally breaking.
It's completely fractured.
The analyst consensus is a complete unmitigated mess.
I don't think I've ever seen Wall Street so wildly divided on a mega cap stock. The variance in price targets is just staggering.
Just look at the breakdown. 32% say hold, 29% say strong buy, 21% say buy, and 18% say sell or strong sell.
It's all over the place.
You basically have a four-way tie between analysts who think it's going to the moon, analysts who think it's going to zero, and analysts who are totally paralyzed.
And this confusion is entirely driven by a philosophical divide in how you build a valuation model for a company undergoing a massive identity crisis.
Which totally explains the massive gap in the actual price targets. Because if you run standard intrinsic value models, meaning you evaluate the company strictly based on its current cash flows and traditional automotive metrics, the stock is wildly overvalued.
Wildly.
These intrinsic models peg its true fundamental worth somewhere between $47.17 and $131.22 per share.
And remember, it's trading right now near $393.
Right. So by a traditional discounted cash flow metric, which looks at the cars they sell today and projects the profit into the future, you are paying a 300 to 800% premium.
Yeah, the math simply does not support the current price if they are just a car company.
But conversely, you have major players like Morningstar coming out and estimating a fair value of $400 per share.
Right, at the current price level.
Exactly. And why? Strictly because they are factoring in the future potential of the Robotaxi network and the artificial intelligence developments.
They're pricing in the future.
They're completely ignoring the cars in the dusty parking lot and placing all the value on the sci-fi server room in the back.
Which brings us to the ultimate question of who actually understands the reality of the business better. The analysts or the insiders running the company.
Oh, let's look at the insiders. The people who literally see the daily sales data.
This is always revealing.
Over the last 90 days, insiders have sold $41.6 million worth of shares.
That's a lot of selling.
Director Kathleen Wilson-Thompson dumped $9.27 million on March 30, 2026. And the chief financial officer, Vaibhav Vatenia, sold nearly $900,000, specifically $899,077 worth of stock on March 6.
The CFO selling is always something to watch.
Meanwhile, insider buying is virtually non-existent. The last notable buy we have on record is from Director Joseph Gebbia, who bought about $1.02 million worth back in April 2025.
Over a year ago.
Exactly. Over a year ago. Here's where it gets really interesting. This is the ultimate undervalued versus value trap debate for you listening right now.
Let's hear it.
If Morningstar thinks $400 is fair value based on this AI future, why is the CFO, the guy who literally controlled the master spreadsheet, taking almost $1 million off the table right below that $400 line?
It's a great question.
Are retail traders walking blindly into a value trap here?
This raises an important question about how we interpret insider trading, especially at a company undergoing a massive, painful transition.
It looks bad.
It looks terrible. It is incredibly easy to look at a CFO selling shares and instantly scream that the ship is sinking. But we have to separate short-term personal risk management from the company's long-term vision.
What do you mean?
Executives sell stock for 100 different mundane reasons. They have massive tax liabilities, they buy real estate, they need to diversify their personal portfolios.
Sure.
Because they are heavily compensated in stock units rather than cash, selling shares is often their primary source of liquid income.
I hear that, and I know executives need to pay taxes, but nobody buys stock to pay a tax bill.
Yeah.
And nobody inside this company has been buying for a solid year.
You are absolutely right. The silence on the buy side is a much more potent warning than the noise on the sell side. Caution is absolutely required before following these price targets blindly.
So they might just be hedging their bets.
The executives might look at the short-term reality, the fact that tomorrow's earnings report might be brutal because of that inventory buildup, and decide to take profits now to protect their own net worth.
Which makes sense.
That doesn't necessarily mean they don't believe in the 10-year AI pivot. It just means they know the next 6 to 12 months are going to be a highly volatile, bumpy ride. They are managing personal downside risks.
Whereas a retail trader buying today might be betting their entire portfolio on a long-term dream without accounting for the short-term pain.
Exactly. They can believe in the 10-year destination while still bracing for a 6-month pothole.
That makes total sense. And that massive philosophical gap between a $47 intrinsic value and a $400 forward-looking fair value.
Yeah.
I mean, it sets the perfect stage for the extreme bull and bear arguments that are actively fighting for control of this stock's narrative right now.
Let's lay out the worst-case scenario first, the bear case.
The bear case is incredibly grim. JP Morgan is actively warning of a potential 60% sink in the stock price due to slowing electric vehicle demand across the entire industry.
60% is a bloodbath.
It's a total wipeout. We already established that automotive gross margins have declined to a painful 17.4%. The company has a recent track record of missing their revenue targets. And the elephant in the room is a glaring $16 billion total inventory buildup. That indicates a severe structural supply-demand mismatch.
People just aren't buying the cars as fast as they make them.
Right. And I have to say, when I look at the mechanics of this business today, I lean heavily into the bear side. A 60% drop prediction from a major institution like JP Morgan isn't just a minor technical correction.
No, it's a structural reevaluation.
It is a catastrophic repricing of the stock based on the physical reality of $16 billion in unsold cars. You cannot just wave a magic AI wand and make $16 billion in depreciating metal disappear from your balance sheet.
Well, if we connect this to the bigger picture, your skepticism is perfectly warranted if we assume this remains purely a car company.
Which is what it is right now.
And that is exactly what the bear thesis relies upon. It assumes the primary engine of value generation will always be manufacturing, distributing, and selling four-wheel electric vehicles to individual consumers.
Right.
If that traditional automotive model is the reality, then $16 billion in tied-up inventory is an absolute disaster that will continue to compress margins. But the bull case entirely rejects that premise.
They just ignore the cars.
The bulls argue that this is no longer an EV car company at all.
It's the transition from hardware to software.
Exactly. The bull case sees this as a robotics and artificial intelligence entity that just happens to currently fund its research and development by selling cars.
Okay, but do they have any proof that the car business isn't just dying?
They do point to surging vehicle registrations in key European early adopter markets like France and Norway as proof that the legacy car business isn't dead, just shifting geographically.
Interesting.
But more importantly, the bulls are looking at the underlying tech infrastructure. They are pointing to the expansion of the Robotaxi testing currently happening in Dallas and Houston.
The autonomous driving stuff.
Right. They are looking at the rapid advancements in the Optimus humanoid robotics program. And they are heavily weighting the massive 1 terawatt AI compute facility they're building.
Which fundamentally changes how you calculate the total addressable market.
Precisely. The bulls argue that the total addressable market, the TAM for a global autonomous transport network and scalable humanoid robotics, is so unimaginably large that a short-term $16 billion inventory glitch is essentially irrelevant on a 10-year timeline.
Irrelevant. That's bold.
It is. A traditional car company might trade at 10 times its earnings. But a software monopoly with proprietary AI trades at 50 or 60 times its earnings. That multiple expansion is what the bulls are buying.
Irrelevant is a very strong word when we're talking about billions of dollars. But I see the logic of the valuation shift. It's the difference between valuing a metal bending factory versus valuing a global software monopoly.
Exactly.
But even the most optimistic bulls have to acknowledge the external real-world risks piling up right now.
Oh, absolutely. The risks are massive.
They're planning a massive $20 billion in capital expenditures for 2026 just to build out this AI infrastructure. At the same time, they are locked in aggressive, margin-crushing price wars with Chinese EV competitors who can produce comparable vehicles significantly cheaper.
The Chinese competition is fierce.
And you have broader macroeconomic and geopolitical tensions, specifically in the Middle East, that could send shipping and supply chain costs through the roof at any moment.
The path to that utopian AI valuation is covered in broken glass. The transition period between car company and AI monopoly is going to require immense sustained capital expenditure, flawless execution by the management team, and a lot of patience from institutional investors who are used to seeing immediate quarter-over-quarter growth.
So we have to synthesize all of these conflicting data points into an actionable outlook for you, listening right now, ahead of tomorrow's massive catalyst.
Let's break it down.
In the short term, over the next few weeks, the data suggests you should expect extreme volatility around tomorrow's April 22 earnings report. If the earnings disappoint and the stock fails to hold that crucial 393 through level, the technical charts show it could trigger a rapid cascading drop all the way down toward the next major support zone at $340.
And in the long term, looking out over the next 3 to 5 years, the success of this stock hinges almost entirely on the successful rollout of full self-driving technology and the launch of their cheaper next-generation vehicle platform to fend off those Chinese competitors.
It's all about execution.
It is. But it is worth noting that market analysts at Capital.com point out a very distinct recurring historical pattern with this specific stock. It has a long, documented history of enduring incredibly sharp, painful sell-offs, which are almost inevitably followed by aggressive, rapid recoveries driven by retail sentiment.
Which brings us right up to the moment of truth. Tomorrow is the Q1 earnings report. It's the ultimate short-term catalyst that will either validate the massive AI spend or punish the stagnant car sales.
It's going to be wild.
Remember to subscribe, like the video, and drop your predictions in the comments. Are retail traders stepping directly in front of the steamroller right now, or are they catching a rocket ship just moments before it takes off?
It is arguably the defining question for this company over the next decade. Because if the intrinsic cash flow models say the automotive business is only worth $47 a share, and Morningstar says the AI and Robotaxi infrastructure brings that value up to $400, you have to ask yourself a fundamental question before you allocate a single dollar. Are you buying a legacy car manufacturer currently struggling with a massive depreciating inventory crisis? Or are you buying the world's most expensive, ambitious AI software startup